You just hit $10,000. In your head, it plays like a short movie. Pay off debt, sleep better, finally feel like, I'm okay now. Then Monday morning shows up. Rent still gets pulled. Your credit card still charges interest, and your account balance doesn't magically turn into a different life. In the US, average rent can easily run around $1,700 a month. Just staying housed can eat more than half of that $10,000 in a few months. And if you have student loans, the typical borrower still owes something like $20,000 to $25,000. So $10,000 isn't the ending, it's a scene change. If you're carrying credit card balance, rates around 20 to 22% are common. That means money can evaporate even when you don't buy anything new. At the same time, the Fed's benchmark rate sits around 3.5 to 3.75%, which sounds far away, but it pulls on everything: car loans, mortgages, and how tight the whole economy feels. So the real question isn't, how do I make $10,000? It's this: why doesn't $10,000 buy safety? Hello, this is Dax. Welcome to Dax Invests, where we share personal finance insights through a personal lens and the latest evidence-based data. Now, let's come back to that $10,000. You thought it was freedom, but in real life, it's more like a life jacket. It helps you stay above water. It doesn't get you to shore. Rent numbers show why this feels so disappointing. On Zillow, average rent is often close to $2,000 a month. And if you're moving, move-in costs can burn cash fast. First month, security deposit, fees. The money leaves quicker than you expect. Here's the psychological part. Even a $400 surprise bill is a stress test for a lot of people. For ages 18 to 29, only about half say they could cover $400 with cash or something similar. So, $10,000 doesn't change your life because it doesn't buy long-term safety. It mostly buys time. And this video is about turning that time into control, step by step, with no hype. You can often see the warning signs before money collapses. They're not loud. They show up in small sentences. Just the minimum payment this month. I'll make it up next paycheck. Buy now, pay later is fine. The problem is, interest doesn't care how tired you are. Average credit card rates in the US have hovered around 20.97% recently. That turns minimum payments into a downward escalator. You feel like you're standing still, but the balance keeps creeping up. And this isn't about personal failure. Household credit card balances in the US have grown to around $1.23 trillion. That means a lot of people are living the same loop. Meanwhile, prices still rise. Inflation around 2.7% means your dollars buy a little less each year. So you're squeezed on both sides. Money loses value. Debt gets expensive. That's why, even with $10,000, the pressure doesn't disappear. If the habits don't change, $10,000 is just a deep breath, not a system. To understand why it still feels hard to breathe, we need to talk about financial shocks in plain language. In the economy, interest rates are basically the rent you pay to use money. When the Fed targets higher short-term rates, like an upper range around 3.75%, borrowing usually gets more expensive down the chain. You feel it in monthly payments. A 30-year mortgage rate around 6% can be the difference between I can manage and I'm stuck. A small jump can erase what little breathing room you had at the end of the month. Now add a second concept: liquidity. Liquidity is like water in a pipe system. When people get scared, they hold cash. Water slows down. Banks can face short-term shortages when withdrawals rise or markets tighten. That's why the Fed has tools like the discount window, a way to pump liquidity into the system. For you, the shock is simpler. Borrowing costs go up, prices stay high, and job opportunities feel uncertain. So $10,000 stops feeling like money. It starts feeling like a shock absorber. To see the pattern clearly, look at Asia in 1997. A lot of people thought, I have savings, I'm fine. Then, exchange rates flipped, capital rushed out, and everything moved fast. When a currency loses value, imports get expensive, And if debt is tied to foreign currency, the debt can swell overnight. You don't need a PhD to get it. Your paycheck stays the same, but your bills jump. In that moment, the exchange rate feels like a ruler that got bent. Same number, less buying power. During that crisis, the IMF helped coordinate large support packages for countries like Indonesia, Korea, and Thailand. The message here isn't fear. It's a lesson about mismatch. Don't borrow in what you don't earn. Don't let fixed costs swallow your ability to move. Because $10,000 only keeps you steady if the ground isn't sliding too fast. Argentina is a painful example, but it's easy to understand. When trust in a currency weakens, people look for shelter. They buy dollars. They buy hard assets. They stock up. And exchange rates become a psychological battle. Argentina has had a long history with IMF programs, and in many periods, the public's trust was already fragile. What does that look like in real life? You go to the store today, same item, different price next week. You sign a contract, but the contract feels meaningless because the money changes value. For young people, the worst feeling is this: I'm trying, but the ground keeps moving. In that environment, $10,000 doesn't change your life. It only delays a hard choice. Move, switch jobs, or borrow more. The lesson for the US isn't America will become Argentina. The lesson is, when systems shake, one lump of money won't save you. Lower fixed costs. Keep debt manageable. That's what actually keeps you alive. Greece gives us a term that sounds weird but matters: CDS. Think of CDS like an insurance price on default. If CDS prices rise, the market is basically saying, I'm more afraid. Researchers and institutions describe CDS as a way to transfer credit risk in exchange for ongoing fees. During Greece's crisis, borrowing costs rose sharply as confidence fell. It's like your credit score dropping. You still need money, but the price of money spikes, and the rules get stricter. This sounds far away, but it comes back to you here. When the price of risk rises, money gets more expensive. Opportunities shrink. And your $10,000 still only covers short-term shocks. Turkey is a lesson in inflation, exchange rates, and reserves, all tied together. When inflation runs high and trust drops, people try to hold safer currency. That pressure can weaken the local currency even more. You don't need to understand the full model. Just imagine this. You earn in lira, but many prices follow the dollar. When the local currency weakens, imports rise. Then, everyday bills rise. At times, Turkey saw inflation surge to extremely high levels. And when markets get scared, risk pricing shows up again, often through things like CDS spreads. Now connect that idea back to the US. A stronger or weaker dollar is also an exchange rate story. Currency stress teaches a very old skill: protect your buying power. Keep your cash flow flexible. Venezuela is the extreme case. When inflation spins out of control, money stops being a reliable measuring stick. In some periods, estimates of inflation reach staggering levels. But the most important part isn't the shocking number. It's the feeling. You can't plan. Saving stops being saving. It becomes a race before your money loses value. When trust collapses, liquidity collapses. People flee to anything else. The local currency gets abandoned. The US is not Venezuela, but the US has a softer version of the same pressure. Inflation of 2 to 3% doesn't sound dramatic, but for someone living paycheck to paycheck, it can feel like an invisible tax. That's why $10,000 doesn't change your life if your buying power keeps getting chewed up and you don't have a defensive system. Now back to the US, with numbers that feel personal. Mortgage rates around 6%. Car loans around 7%. Credit card rates around 20%. This is why a lot of people have income, but still feel exhausted. Household debt is massive. Credit card balances are huge. Auto loans are large. So the survival system for young adults isn't a get-rich plan. It's 3 priorities. 1. Build a cushion for small shocks. Start with $400, then aim for 1 month of expenses. 2. Reduce high-interest debt before chasing big goals. 3. Turn $10,000 into a structure. Separate emergency money, bill money, and only then think about learning investing slowly. Control starts here. Not getting rich overnight, but feeling less afraid when your phone buzzes and says, "Payment due." When a crisis hits, you hear headlines like, "Fed cuts rates" or "Fed adds liquidity." It sounds like grown-up talk, but it affects whether you can keep a job, refinance a loan, or get trapped in high-interest debt. The Fed has a few main levers. 1. Policy rates. They steer short-term rates within a target range. 2. Emergency lending. The discount window gives banks short-term access to cash when markets are stressed. 3. Repo tools. These help keep overnight funding flowing, like opening a valve when pressure builds. And when conditions get worse, the Fed can buy longer-term bonds to lower long-term rates and add liquidity. Here's the point. They're trying to keep the system breathing, but you still have to keep your life breathing. And $10,000 is a small oxygen tank. A lot of people think the biggest risk is, I don't have enough money. But the bigger risk is, I lose cash flow. And cash flow is fragile in your early 20s. Overall, unemployment has been around the mid-4% range, but for ages 20 to 24, it's often much higher, closer to double. Meaning, you're not only competing to get a job, you're competing to keep one. So $10,000 is more like a mattress than a ticket. It doesn't create opportunities, it buys time to find them. And time gets consumed by normal things: car costs, insurance, rent, and months where your mental health is just not great. If you've opened your banking app and watched your balance drop slowly, steadily, that's the moment you realize you're not reckless. Fixed costs are eating your sense of safety. So the question becomes, how do you turn $10,000 into a defensive system against income shock? Picture $10,000, like water in a house. If you dump it all into one bucket, you'll still run around looking for a cup when you need it. A system starts with putting water in the right places. Step 1. Operating liquidity. Keep 1 or 2 cycles of bills in checking so autopay doesn't scare you. Step 2. Emergency money. Keep it in a savings account, or HYSA, and only for emergencies, because even a $400 surprise can break a lot of people. Step 3. Put out the high-interest fire. At 20% credit card rates, minimum payments are like pouring water into a leaking bucket. A small, powerful habit. If you can, set autopay to pay the statement balance. If you can't, set autopay for the minimum plus a fixed extra amount every paycheck. It's not flashy, but it gives you something more valuable than money: peace. $10,000 won't change your life, but it can change your breathing if you use it to build structure. For many young Americans, the debt that shapes life isn't credit cards, it's student loans. Quiet, long-term, always there. Typical borrowers often still owe something like $20,000 to $25,000. And delinquency can rise when repayment restarts and missed payments show up again. If you're close to falling behind, don't wait until it pulls you under. Here's what you can do without drama. Know your servicer. Turn on payment reminders. Look at repayment options, especially income-based plans, before you start avoiding the bills. The goal is simple. Don't turn a long-term loan into a short-term crisis. $10,000 won't erase student debt, but it can buy you time to get the loan back into a controlled state. Now the 3 money vacuums of American life: cars, housing, and rent. None of these are bad. They're just expensive when interest rates are high. Car loans around 7%, mortgages around 6%. And while you're waiting to be ready for a home, you still have to live somewhere. Rent around $1,900 a month is common, and home prices can be far above $400,000 in many markets. So place $10,000 in the middle of this reality. It doesn't solve a home. It doesn't solve a car. What it gives you is choice. Maybe you finance a cheaper car. Maybe you stay with a roommate. Maybe you delay a big purchase for 3 months. This is where you learn the truth. Money doesn't change your life by being bigger. Money changes your life by giving you more freedom in your decisions. You might ask, why should I care about Argentina or Greece when I'm just trying to pay rent? Because those crises show a rule. When trust drops, the price of risk rises. And eventually, that cost lands on regular people. In finance, CDS is like default insurance. The buyer pays a fee. The seller covers losses if a defined credit event happens. When CDS spreads are high, the market demands more insurance. Money gets more expensive. Exchange rates are a mirror of trust too. When a currency weakens, imports cost more. Inflation can spread. And when everyone hoards cash, liquidity tightens, like a whole city turning faucets on, but the water runs thin. Central banks can pump liquidity so the system doesn't seize, but your personal liquidity is simpler. Do you have enough cash to avoid high-interest debt when life happens? $10,000 doesn't change your life. It puts you on one side of a line. Cushion or no cushion. When you're young, the fear isn't, I'm poor. The fear is, I don't know what's coming. And in a world where prices still rise, that fear makes sense. So the strategy isn't getting rich fast. The strategy is reducing uncertainty. Here's a simple checklist for $10,000. 1. Stop new leaks. No new pay in 4. No new loans for 30 days. 2. Lower fixed costs. Shop insurance, change phone plans, keep roommates longer. 3. Build future insurance. Automate a small transfer to your emergency fund every paycheck. 4. Only after high-interest debt is controlled, start learning investing. Slowly, steadily, and with understanding. Here's the weird part. The fewer decisions you have to make in panic, the more you feel like you're on track. That's control. $10,000 won't instantly change your life, but it can change how you respond to life. If you ever thought, when I have $10,000, I'll be okay, you're not naive. You're human. You're looking for safety. But the truth is, $10,000 can't buy a calm economy. It can't buy a job market that's gentle with beginners. It can't buy a home when prices are still high. What $10,000 can buy, if you use it well, is options. Options to not borrow when an emergency hits. Options to say no to a too expensive car. Options to leave a toxic job without fear of tomorrow. Sometimes, an option is as simple as keeping money somewhere safe and easy to access, like an FDIC-insured bank account. If this video helped you breathe a little slower, consider subscribing to Dax Invests. Every week, we'll use real data and everyday stories to make money simpler and a little less scary. I'll see you in the next video.